after this bear market we've been in since January 3rd, a lot of people have sold. A lot of people have already panicked. I think it's too late to panic. Obviously, it felt like the right thing to do this morning, but by the afternoon, that was not the case. I think that increasingly the market may be coming to the conclusion that we're not going to have a hard landing. We're going to have a soft landing. We're actually in a recession right now. It's just what I call a rolling recession, hitting different sectors at different times. And that could continue through year end into next year. And after today's number, I'm kind of wondering whether we also have rolling inflation.
A few moments later.
I mean, it would be presumptuous, wouldn't it, for the market to think that this is, or moving higher today, thinking a soft landing over a hard landing? Really? I mean, given what the Fed is suggesting that it's going to do, and look, some say that these numbers over the last couple of days would suggest that the Fed is right. Kashkari and Mester and others are right, and everybody else saying that they should stop or they're doing too much, don't know what they're talking about.
Sure. Yeah, well, maybe I'm personalizing my own forecast and saying the market agrees with that. That's not a very smart thing to do. I agree with you. But, the problem in our business is we're always asked to come up with why the market's doing what it's doing today. And for all we know, it's a bunch of computer programs running this thing wild, and we're trying to come up with some rational, reasonable explanations for why all these things are happening.
90% of the time, I have no idea what the I'm talking about.
All right. Today is Thursday, the 13th of October, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. Happy CPI Day. And what a day, what a day, what a day it was. Unbelievable stuff. You see, yesterday we brainstormed a lot of scenarios on how the stock market is going to react to the release of the CPI, also known as the CPI. And despite the government's cooks' best efforts to reduce the true nature of inflation in the report. I mean, these government cooks have better cooking skills than Jeffrey Dahmer. But despite all of that, the CPI did show that inflation moved higher year over year, but most importantly, even month over month. And the stock market immediately reacted the way we thought it would by dropping down big. But shortly thereafter came the mysterious rescue operation. And folks, we can entertain the theories. This was the plunge protection team. This was some midterm funny activities to prop up the stock market before the elections. I get all of that. But at the end of the day, it doesn't matter why. What matters is the market handed us a certain piece of action and the puzzles that come with it. And our job to deal with what we have right now and piece the pieces of the puzzle together and interpret what the market is saying, but most importantly, what the evidence says regarding the road ahead. And just a word of caution here. You're gonna hear a lot of these Wall Streeters and the perma pumpers who come on TV and their sole job is to talk their books and pump their portfolios higher. I get all of that. We all want the stock market to go higher. That's how we make money. But the most important question is, does it make sense to say that this is the stock market bottom and higher we go from here? And all of these worries and concerns that they've been talking about in the last few weeks, well, they're now gone all of a sudden. For whatever reason, fill in the blank reason. This is what they've been doing all along. In the beginning, it was, peak inflation. And then when we got the evidence that there is no peak inflation, they said, perhaps a Fed pivot because a financial accident is looming. And when it became clear that the Fed is not going to pivot anytime soon, and now they're back at, maybe the soft landing is back. They even dubbed it as the last gasp of inflation before it cools down. Oh, wait. This is the peak once again. They keep going back and forth. They're confused. They have no idea what they're doing. And you heard the intro, of course. An example, Ed Yardeni saying that we are in a rolling recession. A few months ago, he said there is no recession.
But maybe I find myself in the uncomfortable position of actually agreeing with Fed officials, particularly Fed Chair Powell, who's recently said consumers are in good shape, businesses are in good shape, the banks are in great shape. There's no particular reason why this economy is going to go into a recession. with interest rates having gone up already.
And it was a soft landing, then no soft landing, then back to soft landing. They have no idea what they're talking about. And folks, most importantly, if the market continues to rally for a day or two or a week or two, because there is evidence that supports the possibility of another bear market rally. And we'll talk about that in details in tonight's program. But assuming the market rallies for a little while in another bear market rally, all of these folks who've been coming out in the last few days and saying, oh, the Fed is over tightening, they're risking a recession, the pivot is going to happen, the Fed will be forced to pivot, all of a sudden they're going to go crickets. No more talk about a pivot. They're actually going to go into, oh, the seasonality is good now before the midterms. Or perhaps the soft landing is going to happen after all, because we got a good earnings report or two. Or maybe the economy can handle higher interest rates. And then when the market goes down again, they're going to go back to the same book of crying and begging the Fed to stop tightening the monetary policy. And it's really amazing to me how quick the sentiment can change. Today, as the market was rallying, you have no idea how many calls I got from clients who say, hey, maybe it's time to buy. You see, the market was down big, the CPI report came out ugly, and the market reversed either way on high volume. This is a sign that this is the bottom. I say, look, you want to buy, go ahead and buy. I'm not going to stop you. But if you want me to buy something for you intelligently, using the data and the information that we got today, I can find something for you to buy. You can hold it for a week or two, for a month or two, it doesn't matter to me. But we can find something to buy and play this rebound rally if it indeed happens. I'm going to show you exactly how. And without further ado, here it is, in focus tonight. A rescue operation in the aftermath of an ugly CPI report. And folks, we're going to be fair and balanced here and present both sides, both views, the bulls and the bears. What are the arguments that the bulls have that this is it? This is the bottom. This is the beginning of a legitimate rally. What are the arguments by the bears that say, hey, this is yet another bear market rally and down we go? We're going to present both sides of the evidence and by the end see who has the better argument. We're going to limit the conversation to the technicals because we know the bears have the better argument when it comes to fundamentals. But we have to talk about inflation and the CPI because we got a new report today and we have to cover it. And the CPI is one of the items in the bears' argument. So we're going to start with the bears' side, and the bears would argue this is yet another fake out because, number one, look at the CPI that we got today. The headline reads, prices rose again in September, ensuring more interest rate hikes. Remember, we are at the point here where everybody was saying this is peak inflation. Inflation should not go higher month over month. We should see the impact of interest rate hikes. But look at what's happening here. Month over month, inflation is moving higher again. The trend is clear. We got down to zero in July, and the president came out and said zero inflation. And now we're going back higher again, month over month. So there is no argument for peak inflation anymore. That's trash. That's garbage. Inflation is moving higher. And the likelihood is it will continue to move higher as we see energy prices moving higher from this point on. And another look at it, look at this. The headline CPI in orange pretty much consolidating, but it's going to perk up higher if energy prices continue to move higher. But in green, whatever that is, this is the core CPI, and it is making a new high. So all of this trash talk about, oh, inflation is peaking, it's about to go down, the Fed has to ease, the Fed is over tightening, you have absolutely no clue what you're talking about. You have people like Wharton Professor Siegel who came on TV today yelling and screaming and crying that the Fed is over tightening and inflation is actually going down in real life. What planet is he living in? The core CPI is moving higher despite all of the Fed rate hikes that we've gotten so far this year. You got to be absolutely out of your mind to even suggest that the Fed is over tightening. Or maybe you have ulterior agenda, and that's what it really is. But here's another look. Look at this. Core CPI, once again, shooting up higher. And this is the highest reading in 40 years, since 1982. Again, is this peak inflation or are you people blind? And inflation is now becoming contagious. Inflation is now becoming entrenched in the economy. It's not just goods anymore. Now we're seeing services inflation shooting up higher. Look at the column in white or gray, whatever that is. That's services. And it moved significantly higher month over month. Not to mention food. Not to mention the sticky inflation in goods. And yeah, energy is down a little bit, but energy can come back easy. We have all the tailwinds for energy to make a comeback, be it OPEC+, be it the war, be it the price cap on Russian crude. It doesn't matter. Plenty of tailwinds. The moment the Fed announces the pivot, if it happens prematurely, I guarantee you will see crude at 150. Like that, I promise you. And part of me actually wants to say, you know what? Let the Fed pivot. Let these clowns see what's going to happen if the Fed pivots right now. Let them see with their own eyes. And you know what's going to happen if inflation shoots up higher significantly? They will come back and say, oh, we got it wrong. Nobody can get it right all the time. Meanwhile, they knew all along. But their job is to pump endlessly, to talk their books endlessly. That's what their job is. And of course, we heard the news in the morning, the Social Security is now adjusting the cost of living to 8.7% in 2023, the highest increase in 40 years. And of course, some of the propagandists came out today and said, oh, look at this. The retirees can enjoy more money now. Yeah, but they're down big because inflation is up big. Can you imagine what senior citizens on fixed income are doing right now amidst this insane inflation? I mean, you think these Wall Streeters or the criminals in DC care about people in fixed income? Of course not. You think they care about the millennials who are looking to buy a home? Of course not. But they would say, hey, the Fed needs to ease it down with the tightening because this will make home affordability really bad as interest rates, mortgage rates continue to move higher. Yeah, but what about the price, genius? What about the prices that are skyrocketing, home prices that are skyrocketing, that are out of reach? Even with 2% mortgage rate, you cannot really afford these homes. I'd rather see home prices getting cut by 50% and me paying a 10% plus mortgage rate than paying 2-3% mortgage rate with these insane prices. And on top of that, when we talk about food inflation, in reality, when we go to the grocery store, what kind of inflation are we seeing? And folks, this is month over month. We're not even talking year over year. The numbers year over year are absolutely stunning. But this is month over month. Flour up 2%, pasta up 1.6%.
Motherfucker.
Cookies up 1.5%, cupcakes up 2.5% month over month. This is a horrific inflation report for kids. But hey, maybe now you have an excuse to say we cannot afford it anymore. You can't buy candy or cookies or cupcakes. It's a horrific inflation report for the Maverick of Wall Street too because they happen to have a large sweet tooth. But anyways, pork ribs up 4.1%. Apples up 5% month over month. Vegetables up 2.4%. At least I have an excuse not to eat vegetables. But lettuce up 3.5% month over month. Tomatoes up 6.8%. Unbelievable. Soup up 2.6%. Soda up 2%. Gum up 2%. Margarine up 4.2%. And salad dressing is up 2.4% month over month. And what went down in price? Here it is. How about eggs down 3.5%? Now you might say, hey, you see, Maverick, inflation is going down. Not really. Here's the year over year inflation for eggs, up 30.5%. Unbelievable. Uncooked beef went down 2% month over month, and milk went down by 1.3%. And lastly, salt down by 1.8%. So there you go, peak inflation, right? Let them eat salt or uncooked beef, and I say screw that. It's all about cookies. I want cookies to go down in price. That's what I really care about. And by the way, what happened to the Inflation Reduction Act? When is that going to kick in? Oh, give it time, right? It's not going to happen right away, Maverick. It takes time. Or maybe you need to think your logic. That spending trillions of dollars when you have the highest inflation in 40 years is absolutely stupid. It doesn't make sense at all. But of course, a lot of you are propagandized by the media and the dear leaders, and now you are in complete obedience. You're not even capable of critical thinking anymore. And what are the ramifications from this inflation report? The answer is more Fed action. More aggressiveness by the Fed, not because they want to, but because they have no other choice. You want to talk about the Fed pivot? It's going to happen, but it's going to happen by the Fed becoming even more aggressive. You watch. And now the odds of a 75 basis points in November is pretty much in the bag. We're going to start talking about 100 basis points soon. And even JP Morgan, the Landromat CEO Jamie Dimon says and warns that higher inflation will push U.S. rates above 4.5%. So all of these fantasies that the Fed is going to go to 4.5 and then hold, forget about it. We're now talking about almost 5%. And this happened today. And as we see commodities prices moving higher in the days to come, these expectations will move higher and higher and higher. And another argument by the bears that this is yet another bear market rally, and it's not going to last. I mean, who knows if it's going to last even a day, but the bears would say, hey, commodities are going to go higher because as you can see in the bulls camp, number one argument is the dollar index is going down. But with the dollar going down, commodities prices are going to shoot up higher. So yes, we have the action by the Bank of England tomorrow, ending QE, and if that adds downward pressure on the dollar, you will see an explosion in commodities. Sooner or later, we will see 100 in crude oil futures, and then 105, and then 110. And we still have the winter season and these price caps against Russian crude, which should shoot up the price even higher than that. And what happens when the market realizes that, hey, this is not really good? Yes, the dollar is down, but that comes with a price of higher inflation. And higher inflation means more and more Fed aggressiveness. They have no other choice. Another argument by the bears is, well, you say the dollar is down and it's going to go down from this point on, and this should create a rally in the stock market. The problem is we don't have a confirmation. Look at gold miners today. They're actually down. If the dollar is indeed going down, the ultimate confirmation is gold, aka the mature guy in the room. Gold doesn't like to rally unless it knows for sure that the dollar is about to pull back legitimately. So why didn't gold react positively today to the drop in the dollar? That's a really important question. And next in the bears camp arguments is the VIX. If this is indeed the bottom, as some would suggest, then why didn't the VIX go down big? You see, back in the bottom in 2020, the VIX dropped down in a matter of 2 days by over 50%. Today, the VIX was barely down about 3%. So we don't have a confirmation here that this is indeed a bottom. And then we have history. A lot of folks will say this kind of reversal means a bottom or the bottom. Well, history is not on your side. We will look at the biggest intraday reversals in the Dow. We're not in good company. We see 29, we see the dot-com crash, we see 2008, we see 2020. And a lot of you said, hey, Maverick, I don't understand this when I tweeted it. Yeah, I'm too stoned. I don't know what this means. So let's do that now. So the first column is the most obvious one, the date of the reversal. And then the second column is how much was the market down before the intraday reversal. And the third column is what is the biggest loss following the so-called reversal, intraday reversal? If you see 0%, that means that was the bottom. But in most cases, it was not the bottom. We see more declines before we see the actual bottom. And then the next column says how many trading days after the reversal, the intraday reversal, like we got today, before the Dow made a new low. And when you see 0, that means that reversal was the bottom, but in most cases, we see lower lows after this kind of reversal. And then the next column says, how long did it take after the intraday reversal before we got a new all-time highs? And they give you the date, but the next column gives you the number of days before that happened. And as you can see, it takes sometimes hundreds, if not thousands of days. But the bottom line here is, after such intraday reversal like we got today, it takes an average of another drop of about 13.3% before we see the actual bottom. So if history is right, this is yet another fake out, and sooner or later, down we go. Likewise, and I mistweeted this on my Twitter account, so I had to take it off because I don't want to be accused of misinformation. What I tweeted was the biggest reversal day to day. So you get one down day and then we get a gap up day. And I tweeted that. I should have tweeted this instead. The largest intraday reversals in NASDAQ history, similar to what we got today. And as you can see, look at the dates. 2008 before the crash, the early 2000s amid the dot-com crash. These are the kind of periods where we see this kind of phenomenon of a gap down, major loss earlier in the day, yet the stock market stages a recovery, a massive one, and closes in the green for the day. We've seen this before, folks. This is nothing new, and this kind of phenomenon happens right before the crash. Matter of fact, the largest intraday reversal was in October 10th, 2008. Don't you see the similarities here? An October intraday reversal where everybody thinks this is it, this is the bottom, and then the crash happens. Anyways, here's what the bulls are going to argue with. They're going to say, look, the dollar is down. The dollar appears to be done here. And if the dollar goes down, this was a major headwind for many companies, and we talked about some of them in yesterday's video, the likes of Nike, where the strength of the dollar is actually hammering all of these earnings. And when the dollar goes down, that gives the market the room to rally, at least for these stocks. When we look at the dollar, it looks like it made a lower high. And we'll talk more about the chart of the dollar in the charts analysis, but this is what the bulls are going to argue with. The dollar is going to go down, and therefore equities will rally, and this could be the bottom. They're also going to argue that the British pound is rallying for now. It appears that it did bottom, and if it does rally from this point on, the dollar would go down. When we look at the chart of the sterling, we have a steep decline year to date, but now the chart appears to be oversold and it made a higher low. Yes, the downward trend remains intact, but who's to say that the sterling is not going to make a higher high and break the downward trend? And if it does, the dollar goes down. We have a top in the dollar, and that solidifies the argument that this is the bottom because we have a top in the dollar. What else? The bulls are going to argue that the 10-year yield, which has been a major headwind for equities, well, it appears that it is topping. Maybe we're seeing a double top formation and down we go from this point on. Why didn't it shoot higher in reaction to a hotter CPI? Isn't this a sign that this is the top for the 10-year? I disagree, and I'm going to show you why in the charts analysis, but for now, this is something that the bulls can hang their hats on. And lastly, they're going to say, look, we have a lot of technical support here, specifically S&P 3500. Why was this important? Here it is. This is a daily chart for the SPX. When we use the Fibonacci retracement levels, you can see that 3500 is a really important level. It is an important support. And when we zoom into the chart, you can see that the chart did indeed rebound pretty much exactly from 3500. And look, we talked before in this program about Katie Stockton, who is the most accurate technical analyst year to date. She's been getting it right, spot on, almost to a creepy level. And now Katie says that the market is poised for a significant relief rally after a test of 3,500. What is she talking about? The more than 4% swing in the S&P 500 today is of little surprise to Stockton, who told clients in a note on Thursday that the index was gearing up for an imminent test of a key support level, 3,505. That level represents a 50% retracement from the March 2020 The Thing lows of about 2,200 and the January high of about 4,800. According to Stockton, any relief rally that takes hold in the stock market could send the S&P 500 to its first big resistance test around 3,914, which represents potential upside of about 9% from Wednesday's close. However, still, even if such a move occurs, Stockton sees deterioration in long-term momentum indicators and would use rallies as an opportunity to sell. I have no reason at all to doubt Katie Stockton's judgment here. If she says that we will see a relief rally, then I'll go with that. I might disagree with the target. I think 3,900 is a little too rich, but the end result is the same. We might see a significant relief rally, specifically if the dollar goes down, specifically if the 10-year goes down. And do you really want to be stubborn enough to fight against this wave? Not me. I'd rather look for opportunities, and I'm going to talk about these opportunities in the heat map analysis. But we need a confirmation here, folks. We can't just take comfort of a knee-jerk reaction. And the confirmation would be, number one, the dollar indeed topping and going down in the next few days, losing key support. And number two, the 10-year yield has to give us a confirmation that this is indeed a double top and it should go down from this point on, losing key supports. We're not going to wait for all of that to happen, but we just need a hint that this is indeed what's going on. And this will give us a relief rally. On the other hand, if we wake up tomorrow, for example, and realize, hey, wait a minute here, the CPI was too hot, the dollar is moving higher again, whatever happened yesterday, maybe the algos and the robots went rogue, maybe it was the PPT, maybe it was funny business, the little guys with the green hats, I don't care. If we get something that negates the fact that the dollar is indeed topping and making a lower high, or any evidence that the 10-year is not making a double top, then we know that this was a fake out. It's going to fade away right away. Anyhow, folks, we got to move on here and cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average staging a major comeback and closing in the green by 827.87 points, or a gain of 2.83%. The Nasdaq closing in the green by 232.05 points, or a gain of 2.23%. The S&P 500 also in the green by 92.88 points, or a gain of 2.60%. All sectors in the green. We're not going to shame anybody, but at number one, capturing the gold medal, energy, and at number two for the silver silver, financial. Number 3 for the bronze, technology. The advance to decline ratios, NYSE 83% advancing versus 15% declining. The Nasdaq 69% advancing versus 28% declining. Commodities, what's going on here? You want to celebrate the dollar being down for whatever reason and push equities higher? Well, guess what? Equities are not going to rally alone. It's going to be commodities too. And today we got major gains in energy commodities. Both the WTI and Brent closed the day with gains of over 2.25% apiece. And gasoline RBOB, similar story here. Heating oil up by almost 4% for the day, and the same goes for natural gas. When it comes to softs, we have a rally in cocoa worth about a little over 2.5%, and then we have lumber with gains of about 2%. Sugar was modestly in the green. On the other hand, cotton was flattish, be it to the downside, while we have major losses here for coffee futures worth about 4%, followed by OJ with losses of about 2%. And this is really important. Look at the performance of metals. If we have a legitimate decline in the dollar, metals should be surging higher, but they're not. Matter of fact, gold and silver were down. Palladium was down. Yet we got some mixed signals here because we got a rally worth about 2% in platinum and another rally worth about 1% in copper. We'll see what happens in the next few days. But when it comes to meats, muted, slash in the red by a little bit across the board. When it comes to grains, we have some rebounds here, some gains for soybean oil, corn, wheat, oats, yet we have modest declines for soybeans, soybean meal, and rough rice futures. Moving on to the big casino, the options market, what's going on here? The volume moved slightly higher. We're seeing the put to call ratio improving by a little bit, yet we still have traders buying more puts, betting that this will be a short-lived rebound. At number 1, Tesla, the souffle, with around 2.8 million contracts traded today. About 55.5% of those were calls. And at number 2, Apple, with around 1.8 million contracts. About 54% of those were puts, not calls. At number 3, Amazon, with around 1 million contracts traded today. About 54% of those were calls. On to the unusual activities that we got in the market today. Most of them are bullish, most of them betting that this will continue. And this is quite an unusual one for CAT, C-A-T, Caterpillar. Somebody's making a major bet for a major rebound coming here for the name. They bought the 195 calls for the expiration date, December 16th, with expectations that CAT can rebound and gain more than 6.5% by then. They paid around $6.50 a piece, all in all spending around $15 million. And then we have the XLE, the energy ETF. Somebody's fading the rally, says perhaps energy is not going to join the rebound, and they bought the 76 puts for the expiration date, November 4th. Of course, they're betting that we will see pressure from the administration to push oil prices down before the elections. They paid around $1 a piece to enter this trade, all in all spending around $2 million. And what about the IWM, the Russell 2000? Somebody's betting for more gains to come, and they bought the 180 calls for the expiration date October 28 with expectations that the IWM could rebound higher or continue in the rebound and add at least 5% by the expiration date, and they paid around $1.50 a piece to enter this trade, all in all spending around $2 million. And then what about the ticker AMZN, Amazon? Here we have somebody fading the rip. Amazon was a laggard despite the rally, so somebody sees weakness here, and they bought the 101 puts for the expiration date, December 16th, with expectations that Amazon could lose more than 10% of its value by then. They paid around $4.75 a piece to enter this trade, all in all spending around $3.5 million. At the bottom of the table, what about the ticker C for Citibank? We have banks' earnings starting tomorrow. Somebody sees bad news for Citi. They bought the $40 puts, at least hedging here, maybe a shareholder, for the expiration date, October 28, with expectations that Citi could go down and lose more than 7% of its value by then. They paid around 85 cents a piece to enter this trade, all in all spending around $550,000. And then what about the trade for the ticker QQQ, the Nasdaq? Somebody's fading the rip here by buying the 246 puts for the expiration date, November 18th, with expectations that the name could move down and lose more than 8.5% of its value by then. They paid around $4.50 a piece to enter this trade, all in all spending around $3 million. And lastly, what about the GLD, the gold ETF? Somebody sees an upside here despite the muted reaction that we got today, and they bought the 163 calls for the expiration date, December 16th, with expectations that the GLD could move higher and gain more than 5% by then. They paid around $2.20 a piece to enter this trade. All in all, spending around $900,000. On to the heat map. What do we see here? A sea of green, but we have some exceptions. Some of the software names did not do pretty good, such as Uber, for example, ServiceNow. They were laggards for the day. And of course, what sticks out is Amazon not joining the rally, and the Chinese name Alibaba, JD, all down. And of course, the underperformance by gold. If the dollar is going to go down, and this is the thesis behind the rally, then why didn't gold futures join the rally today? If I had to comb through the gains and assume that the dollar is going to go down, and this will be the main thesis for the rally, I'd rather be in energy, folks. Yes, we have the elections around the corner, or might see some funny actions by the Joey B administration, or whatever. But for now, the dollar going down, the OPEC plus cuts, on top of that, the upcoming price caps on Russian oil. You got the combination for a sustainable rally in energy from this point here. And I said before, if we have a dollar-based rally in equities, I'm going to go with commodities, but specifically energy. You can buy the agricultural names, the fertilizer names, as natural gas goes higher. But I'm also sticking with names such as Devon Energy, Occidental, Schlumberger. I also got some natural gas names such as Coterra, EQT, etc., etc. So I'm going to stick with energy here. I might dip my toes and play a rebound rally in the giant multinational companies. If the dollar goes down, their margins supposed to improve. And we're talking about companies like Coca-Cola, Mondelez, the defensive consumer staples, Hershey's, Kellogg's, etc. But I'm not going to dip my toes in the riskier names, the high beta, high multiple names. The moment we see the 10-year and yields moving higher again, the rally in these kind of names will fade away right away. So remember, we have two arguments here on why the market rallied today. Theory number one, the dollar is going down. Theory number two, the 10-year is going down. If you put your bets on the 10-year going down, you should go with technology and the riskier beta names, the RKK kind of names. But if you're betting that the dollar is going to go down, and this is the main thesis for the rebound that we got today, like me, you're going to stick with commodities. I bet the dollar goes down if this rally sustains, but not the 10-year. So I'd rather stick with commodities here. Anyhow, let's talk about some corporate news. I remain a shareholder of Kroger, and today we got news that Kroger might end up buying Albertsons. We have some more M&A news, and I said this is not the time for M&A. They're doing it anyway. I don't believe the regulators are going to allow this because it's too much consolidation. And maybe that explains why Kroger shareholders were not upset. And then we have BlackRock, and apparently the assets under management for BlackRock went down by 16%. And this is a major deal because BlackRock happens to be one of the top companies with assets under management. So when we say 16% down, think about the trillions of dollars that BlackRock lost in the assets that they manage. And then we got Netflix. You might have heard this news, and the stock shot up higher today, that we now have a new tier. It is $7 a month, but you get ads. And I say, what is the point here? Like, couldn't you pay $3 extra and get the basic package? Who are they targeting with the $6.99 a month with ads? On the other hand, if they made it free, we would have seen a large percentage of cannibalization. So perhaps this is, I don't know what this is. I'm not sure that this is going to work to begin with. But for now, the stock is down big. Investors are going to use any excuse to buy the dip, and the shorts will look at this as a covering opportunity. On to the heat map for the ETFs, a sea of green across the board. But here's the take, folks. Pay attention now. The rally was not led by growth. Matter of fact, value outperformed growth, be it the IWD, be it the VTV. What does that say? The rally, the majority of the rally was based on the decline in the dollar, and therefore commodities led the rally. Look at the XOP, XLE, and most importantly, the OIH was up big today, the UNG for natural gas, even metals ETFs, the XLB was up big, almost 3%. And of course, financials ahead of reporting earnings, the KRE, XLF, lots of short covering here. So my hunch is this is not going to last for too long. We're going to comb through the gains and either stick with the decline in the yields, meaning technology leads the rally, or the decline in the dollar, meaning commodities lead the rally. To figure all of this out, let's move on to charts. We start with SPY 30 minutes chart. What's going on here? Obviously, the mysterious rebound. The RSI was not that oversold, but I believe the algos initiated the buying because 3500 SPY got hit. S&P 500, I should say. And immediately, the robots bought the dip right away, and the humans followed, and we see the chart of the SPY not just closing the gap, not just closing above the June bottom, not just recapturing the June bottom, but also bumping its head on the next resistance at around 368. Lots of technical strength here. The question is, do you fight it? The answer is, you're not going to fight it until we see the June bottom lost once again. And here is the S&P 500's futures contract, and as you can see, not a lot of progress here. The only thing that happened is recapturing 3,600. Yes, the volume was up, but again, is this a one-day phenomenon, or is this the start of a new regime of more and more buying and deployment of liquidity? If it is, then we could see this one sticking for a little while. By this one, I mean this rebound. Not a lot of improvement in the momentum indicators, so we need to see a lot more. We have 1 day left for the week. It will be a win for the bulls if they at least close the week above 3,600. And it would be a major victory for the bears if they manage to close the chart once again below 3,600. It's a difficult task, but if they do it, they will solidify the fact that they have the advantage and they are indeed in charge. The Qs, 30 minutes chart. What's going on here? Again, the gap and then the rebound, not only closing the gap, by the end of the day, not only recapturing the support from the previous gap, but also going all the way to the June bottom at around 269.29, but not closing the day quite above that. So we have a cliffhanger here. We'll see what happens tomorrow. But for now, do you want to fight it? You gotta wait till we see more signs, such as the SPY losing the June bottom, such as the dollar rebounding higher, such as the 10-year making new highs, and then you know that this is over. Here's the continuous contract for the Qs. Again, there was an attempt to recapture the June bottom, which happens to be 11,058.5. The volume is higher, but we're not going to read too much into it, and no major improvement in the momentum indicators. So for now, it is just a beginning of something. And we get a confirmation, because without a confirmation, the previous theme, which is more selling, will resume. What about the IWM, the Russell 2000, 30 minutes chart? What's going on here? We got the gap down and then the rebound in or around 164.91, which happens to be in or around the June bottom for the IWM. And then what happens? The chart recaptures 168.90. It closes the gap. It's not quite above the most important number, in my opinion, which happens to be 174.22, but so far so good. But you're not going to fight this until you see the support of 168.90 being lost by the end of the week. A weekly closing below 168.90. But most importantly, the dollar has to rebound before we say fade the rip, because for now, the bulls are winning from this argument alone. You got a lower high in the dollar, we got negative divergence on the RSI, and on top of that, the argument is, what if this is a reverse ABC pattern? And down we go. And if it is, equities will rally on that alone. However, look at what's going on with gold. No rally here, no response to the drop in the dollar at all. Gold is still holding at 1,671. And the argument here is, if gold follows with the program that we got today and the dollar continues to go down, we could see an ABC pattern, which could, keyword could, get us all the way up to 1,763. And then a daily chart for crude oil Brent. What's going on here? We have a rebound, and the assumption here is that this could be an ABC pattern. And if it is, we could see oil at 105.43. Entirely possible. What about the 10-year yield, the daily chart? What's going on here? The argument for now holds that this could be indeed a double top. The problem is, the moment the chart makes a higher high and breaks above the double top formation, all of these hopes go out of the window. And we do have a leading indicator here in the 2-year. Unlike the 10, the 2-year shot up significantly higher, meaning the yield curve is actually inverting more. Not a good sign. And then what about the TLT, 30 minutes chart? What's going on here? We got a gap down and then a recovery, closed the gap but did not close the day above the gap. So this is bearish, not bullish. However, the bulls would argue, what if this is a saucer bottoming formation? So you're not going to bet against it until we make lower lows. The VIX 4 hours chart, what's going on here? We have a confirmation of a loss in momentum from the MACD indicator, but the problem is, for the bulls at least, market bulls, why didn't the VIX flush down significantly? It didn't even close the gap at 31.41, as if the VIX is saying, okay, I'm going to play with this for a little while, I'm going to go down a little bit, but once this rally is over, and it's going to be over soon, I'm going to shoot up higher and recapture 33 as support and unleash a major rally. So we need to see more improvement here in the VIX. By improvement, we mean more downside if you happen to be bullish the market before we say, okay, we got the signal of the all clear and the rebound could last and sustain. Here's Apple, a daily chart. What's going on here? A major and historic candle in Apple. It recaptured two supports, number one, 138.79, and number two, the gap at around 142.7. So far, so good. But it has another gap at around 145, and then, of course, the most stiff resistance at around 150. I doubt it's going to happen. The volume went higher today on a buying day. This is a good sign for the bulls. The momentum indicators are improving from daily basis, but they remain negative on the weekly charts. So for now, the assumption is this is a dead cat bounce, a rebound, a bear market rally, whatever you want to call it. Doesn't matter to me. The question is, how far will it go? Because if it goes above 150, then we have a major change here. We'll see what happens, but I doubt it's going to make it all the way to 150. Here's Tesla. 30 minutes chart. What's going on here? We have a gap down to the target of 206.86, almost to the penny, and then a rebound and a formation of a bull flag pattern. The assumption here is, after major declines in Tesla, we should see some short covering here, and it could take us all the way to 233.33 by the end of the week. And lastly, tulips, Bitcoin. What's going on here? Initially, we got a flush down all the way to the lower target of the range, the consolidation range, and then came the rescue operation, the recovery, doesn't matter what you want to call it, but we are still within the consolidation zone. So nothing happened here, no update at all. And here's the recap. This is what we looked at yesterday. The daily charts of the indices were bearish. Gold was bearish. Apple was bearish. Tesla was bearish. Yet we got some improvement toward the bullish side by yields and the Dixie and the VIX. Not by a lot, but here's the update. Now we have the daily charts of the indices moving a little bit away from the bearish camp, and then yields and the Dixie moving closer toward the bullish camp, and then gold remains in the bearish camp. The VIX actually moved closer toward the bearish side, in my opinion, because why didn't it go down big today? This is a sign of, once again, relative strength, and that moves the VIX closer to the bearish camp. Apple, Tesla, all moved closer to the bullish camp today, so we have some improvement here in the bullish case. Bitcoin, of course, remains neutral for now, until we see a break one way or the other outside of the consolidation range. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have retail sales, and then we have the import price index, along with the University of Michigan Consumer Sentiment Index. This is an initial reading. And then we got business inventories and a bunch of Fed zombies speaking. Anyhow, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again over the weekend. Take care.
Welcome to the death of the age of reason. There is no right or wrong, not anymore. There's only being in and then being